When I made some discoveries in 1999, those discoveries would be wild impact to the consumer. And the reason it didn't make the light of day because the industry perceived that the revenue they would generate from those ideas and those concepts were not enough. I accidentally did a quote that was not immediate. When I got the quote and it showed north of a 7% IRR, I knew that I had made a mistake. This isn't a mortality-driven product. This is an interest rate-driven product. I said, this product doesn't exist.
Everything that you said, I would be in your camp if that's what's being sold. I'm not pro life insurance in that scenario. Like, I get it. What I find is it's frustrating because then they almost make it sound like that's how everything's being sold.
They spoke the word of annuity as though I would use the word stock or bond. They were creating that single word annuity was singularly representing a very bad product. But in the process, they had no problem exploiting all the annuity marketplace by helping influence the idea that they're all bad, even though they were really talking about one of 42 types of annuities.
You went from the company that literally uses annuities to market why you should work with them on how they're terrible, horrible. They even acknowledge and potentially would support certain type of annuities.
Yes, that's correct.
Curtis, welcome to the BetterWealth Show.
Thank you for having me. It's a pleasure to be here.
Okay, so you are an actual legend. You have more experience in the industry than I've been alive. I want you to know that. You have a software. I've heard that you are one of the creators of the DIA. We're definitely going to talk about that. You are good friends, very good friends with our Tom Hegna. Many people that are in this space who are industry leaders have credited you as being the thought leader, the person that's educated. You have not only the academic space where you're like helping people academically in the retirement space, but you're also an advisor helping people. So we could talk about lots of things. Our audience wants to be more efficient. They want to take their input and be more efficient with what they're doing in the future. And I interview people like yourself to get different perspectives and try to help elevate the financial IQ. And so with all of that, you just got off stage speaking to Tom Wall's event. There's 400 advisors in the room. If you had to summarize your talk and you speak across the country and probably internationally all over, what is the theme that you talk about? And if you had to like summarize your life's mission in a few words or a few sentences, what would that be?
Learning to be a ferocious consumer advocate above all else. And when you focus on the results of the clients who entrust you to their assets, more than you focus on your revenue, the revenue follows the results of your clients. And so those, when I made some discoveries in 1999, I realized the industry was never going to tell me about those discoveries, but those discoveries would be wild impact to the consumer. And the reason it didn't make the light of day because the industry perceived that the revenue they would generate from those ideas and those concepts were too low of hanging fruit or too high of hanging, it was not enough for them to actually put their effort and time to. And so a sacrifice to the consumers over what was possible was ignored because of revenue. And so when I realized that, I got really mad at the industry for not telling me what I had to discover on my own. And I wrote down on the calendar that day, God's mission, it was in my life, and that was to become a ferocious consumer advocate and worry more about their results than my revenue. And when I did that, things take care of themselves.
What was that discovery in 1999?
It was the discovery of what would now be known as the deferred income annuity. I had a client that was retiring at 51 very early. And back in those days, I was using laddered bond strategies and equity portfolios to manage both income, risk, and growth. And for high tax bracket earners, we used a 5-year period certain SPIA contract, which would create about 4.75%, 5% IRRs with a very high 85, 90% tax exclusion. And so the higher the tax bracket, the more the exclusion really benefited than that cost and the benefit to the consumer. And accidentally did a quote that was not immediate. It was when I got the quote and it showed north of a 7% IRR, I knew that I had made a mistake.
Yeah.
This didn't make any sense. This isn't a mortality-driven product. This is an interest rate-driven product. And so when I reached out to the chief actuary of Prudential, the company that I was getting the quote from, I talked to a man by the name of Joel Sklar, and I said, Joel, something's wrong. I'm getting a wrong IRR on this quote. And so he'd asked me to fax it to him, and he called me a couple hours, which I did. And when he called me back, he says, well, you've discovered a golden jewel. And I said, well, what do you mean? What's the golden jewel? And he said, read the income start date on the quote. And thinking I was doing a 5-year immediate, I read the start date, but it didn't speak to me because when you don't believe something's even possible and you read it out loud, you can't even hear what you say. And so I read it and I said, I don't understand. He goes, read it again. I read it a second time. I said, I don't get it. And he goes, read it really slow this time. And so I read it a third time, really slow. And I go, wait, that's 10 years from now. And he goes, yeah, that's it. And I go, what's it? And he goes, that's the reason the IRR is so high. I said, this product doesn't exist. And I come to find out that back in 1979, this company had developed structured settlement for plaintiff lawsuits. And they had created the opportunity to sell one off. Wasn't a real product. They called it a deferred SPIA, and which is an oxymoron. You deferred and immediate in the same, like that doesn't make any sense. And so the concept of a deal had already been invented under a structured settlement plaintiff lawsuit. But I saw the vision of what that could create if the actuarial science was the same and the rate was driven off the same values. I realized that we had a product that could be used in broad-based retirement income planning. And so that kind of started me up. Now, what Joel would tell me that day is the reason this has never made the light today. It's been around for 20 years, but not in the way you're talking about it. We have to approve the advisor. They have to be a certain size of case, and we'll let this be one off. But it's not, you can't just go around selling this product, but you're not going to hear a wholesaler talk about it. You're not going to, hear it about a company meeting. He says, you discovered it. But he said, if you do something with it, you're not the first to find it. But if you do something with it, you'll be the first to do anything about it. Wow. And I said, why? And he says, because of revenue. I said, I don't understand. He says, well, see, if you manage assets in the market, you're going to get 1% on average. He says, by the way, do you sell our variable annuity income rider? And I said, yeah, I sell a lot of it. And he goes, what percentage of your revenue represents that product? And I said, about 40%. And he goes, what are you getting, 4.5, 5 with your contract with Prudential? I was an employed agent with Prudential. And I said, that's probably right. He said, let me tell you what we're going to pay you if you sell this. Hold on to your hat. Because we give you pension and benefits and health insurance, we'll pay you a grand total of 1.6 once and done. And that's why you won't sell it. That's why I won't sell it. That's why the manufacturer doesn't want to broadcast it. You're going to get 1.6. He said, Curtis, can you afford those 3 kids in that hobby farm of yours? If you take 40% of your revenues and you give the clients 30% discount to their income with higher IRRs, can you afford 1.6 on 40% of your revenues? And I said, I cannot. But here's what I said to him. I told him a story about the feedlot when I was 9 years old, hanging out with Granddad, standing in the shade eating a peanut butter and jelly sandwich. When my granddad went over to do a task while we were eating lunch that day and about got injured, and I ran over. I could see how to do it differently. And I ran over and said, Granddad, watch this. And I showed him how to do it better, safer, and quicker than he was doing it. And we went back to the shade and we're eating our sandwich. And Granddad looked at me and he said, son, one of these days you're going to be working for somebody. And when you see how to do something better, faster, and safer, even if it cost you something, you can't go to bed in the night and wake up the next morning without being imputed by that knowledge. And your job is to never be imputed once that knowledge is given. Now, I didn't know at 9 years old what Granddad meant by imputed knowledge. Those were the words he used with me. My granddad was very anecdotal. But that story, that movie frame, standing in that feedlot, came back to me that day on my drive home. And what I told Joel is, I don't know how I'm going to afford it, but I promise you I'm going to figure it out. And that's when I went back to my office and I wrote on my calendar, God's called me to be a ferocious consumer advocate. Until this day, from that day, I have done my best to not be influenced by revenue or products or what people think, what people tell me. I want to cut to the facts. I want to know what creates the most efficient retirement plan as a collection of product tools, all of them, assets under management, ETFs, 42 types of different annuities that do different things. I want the right tool for the job. When I go put a screw in the wall, I ain't grabbing a hammerhead. And when I'm putting a nail in, I'm not grabbing a screwdriver. And it's understand we shouldn't be using Swiss Army knife of tools that proclaim they do this and that and everything. We pick the tool for the job and we put them together in unison for the best outcomes of legacy, income, safety, efficiency to tax. And that's a collection of both insurance and investment tools collaboratively done under a dynamic tax analytic. And that's why we create software. That's why we created the product. That product was missing from the subset of other products. So that product in and of itself is nothing special. It's a hammer, it's a screwdriver. But when a nail's being nailed or a screw's being put in on the wall, it's the only tool to do the job. It adds to the flavor and the possibilities of every other tool when collaborated. And so from the derivative of the DIA being developed, and by the way, I named it. Actually, I started off calling it a SPDIA. If SPIA was single premium immediate income annuity, I thought, well, deferred should be single premium deferred annuity. Well, that went over like a lead balloon, so I changed it to DIA, and it hung on. And so as a result of that, a deal was established, and that a little bit of a story, just briefly. I wrote an article about my discovery, and the chief actuary at MetLife, his name was Garth Bernard, had been with MetLife in their fixed income division. He called me up one day from New York and said, "Hey, I read your article." And he goes, "I'm writing an article called 2 Bites of the Apple." And he said, "I want to come meet you." He says, "Where's Burlington, Iowa at?" And so he bought an airplane ticket and he flew, signed an NDA, and I spent 2.5 days with Garth Bernard. Crickets for 4 months. And suddenly one day I get a phone call from Garth saying, "You're on to something. You're on to something really big. And this doesn't have to be a 1.6 once and done product. If it's that good for the consumer, the industry can pay appropriately for this." And he said, "I want to develop the product." And so he says, "If you'll develop an LLC that I can own a 39% stake in," he says, "I'll be your CEO." And he says, "We're going to develop DIA products." He says, I got a vision for another product that lets us push RMDs down the road to age 85. We would now know that as the QLAC. So Garth took the idea of the QLAC to the regulators clear back in 2007. And while on my watch as my CEO, we were able to get that all the way through the IRS and prove through in July of 2014 as a product, a derivative of the D. It's got to be a DIA chassis, can't be anything else. And so Garth also helped me develop the software that we now have. And so, that's because I was bound and determined that there was going to be a way, I didn't know how, that I could figure this out. Now, I just simply wrote an article. And somebody called me and flew from New York City to Burlington, Iowa, and we changed the world with that meeting. We changed everything about what would happen in the future. And so one of the things I would say to advisors is when the industry thinks that they provide to you all they want to offer, and you find something that's not being offered but's better, I challenge every one of us to well up inside and say, well, do I have to stop at the edge of the sea because that's the line? Or can I push the waters back and make the edge a different place, right? That's what God did with mountains and the sea. And so I just don't believe there are any limits. I don't believe there's any challenge that's worthy of benefiting our clients that's not worth going after. There are certain things that maybe I perceive in the beginning as a good thing, and I find out later that maybe it's not so good, and I need to abandon some of those projects. But sometimes there's something so woefully correct and so right. And sometimes your inner soul and the spirit that's above us speaks to you in a way that you just know you're onto something. And I that day knew I did. And let me tell you how I afforded this. I realized after, I suffered for a couple of weeks trying to figure out how could I be imputed by the knowledge? How could I really make this happen? Because the reality was I had 3 kids. I had a hobby farm. 40% of my revenues were buying income and chasing alpha, and I couldn't do it flipping them all to this product that had no fee drag whatsoever. And I realized that if I had $50,000, $100,000 in the bank, I could afford a period of time to be able to reduce my revenues from 4.5 to 1.6.
So it's a volatility buffer while you're accumulating.
Yeah. And so I own 40 acres of hardwood timber. And 2 years before this experience, I had the county was bringing city water back to the county, and they hired a state forester in the state of Iowa to come out and tell me what impact these lines 3/4 of a mile back into the woods was going to have on my land. And the forester happened to notice I had all these hardwood mature timber, red oak, white oak, hickory, cherry. And he said, you need to harvest this mature stuff. It's going to get too big. It's going to rot. It's going to decay. It's going to be worthless. And right now it's worth a lot of money. There's young stuff that needs to get light and breathe. And he said, you need to go through and thin the mature logs from the new logs. And I remember telling that forester I was a tree hugger and I wasn't cutting my trees down and get out of here and don't need to talk to me about it. But I did keep his card. And one morning when I was praying to God, how can I be imputed by their knowledge? This second weekend, I'm sitting on a stump. It's 4:00 in the morning when I go down the hill to the Babbling Brook. And by the time I come up the hill, 5:15, it's that moment in the morning where the daylight starts to hit the eastern horizon and the sky starts to be translucent. And I saw the hardwood timber in that sky that I didn't see when it was dark at 4 a.m. And I remembered this conversation with this forester, and I remembered his card was in my desk. I went to the office that day and I go, how do I do this? And he told me a logger to call, and he said he'll come out and he'll price the timber. He'll mark what he wants. He'll give me a standing price for it comes on my property. He wrote me a check for $122,000 so I could harvest these mature logs and preserve my forest. And guess what? That was enough for me to have the courage to say I can afford to be imputed by the knowledge. And I didn't let revenue stand in my way. I sacrificed mature logs on a 40-acre lot of ground in a hardwood timber to be able to afford my passion, my mission, my belief. I sacrificed it to actually do this. Now, looking back all these years later, that was 1999. That was January of 99. Would you ever say that was a sacrifice of my assets? No. It was a blessing.
It's an investment, one of the best investments you could have ever made.
And I couldn't perceive the outcome.
Yeah.
And so that's my story. Each of you have your story. There's something you're being challenged by, and there's a big hurdle, an obstacle. There's a fear of failure, fear of not making enough. And we just can't let these things stand in our way when we see something that's so right. And that was the story of the Dia.
Well, I have so many questions to ask you. Number one, I got emotional and goosebumps when you shared your story and about even what you were told at 9 years old. So thank you for being authentic and sharing that. Why do you think our industry and profession has a lack of vision and entrepreneurship? It feels like it recruits a lot of people who don't necessarily have the tenacity or the vision that you just shared. And I'm curious why, you've been in this industry over 29 years. What is there a reason you think that is, or do you think that's just a mischaracterization of what I just said?
I think there's a lot of reasons for this, but probably the one that's most obvious to us all is we want everything now. We want everything fast. New advisors hear about what mature advisors are doing in production, and they want that production now. They want to proclaim these accolades now. And so they take shortcuts. They're not in it for the long haul. Well, they think they are. They convince themselves. But by the way, when those results don't happen to many of the new guys that get into our industry and gals that get into our industry, what happens to those guys when they don't succeed? They disappear,
yeah.
Right?
The failure rate's massive.
I mean, I want my sandwich now at McDonald's, right? I want my McDonald's delivered, right? I want it now. It's a now society. I think that's one of the biggest reasons. And so you can't have what's good now.
I agree.
It takes time and maturity and lessons. You got to learn. You got to earn your wings, but it's worth it.
Yeah. Yeah. We met at MDRT. Do you remember when we spoke? We spoke on stage. It was when there were 3 speakers at the same time.
Yeah, I do remember
Orlando.
that.
It was kind of a little bit interesting.
Wow.
It was we met there, and you didn't hear my story. I don't nearly have the story that you have, but I started my business when I was 21 years old. I had $20,000 in the bank, decided to stay at home to keep expenses low, and deferred years of making a quick buck to learn from people like you. And I look back, and it was like, was that a sacrifice? I built the foundation to what we're doing now. was one of the best decisions that I've ever did. And yet I see so many people, they get in and they need to make money immediately, and you can smell it from a mile away, and they're undercutting themselves in every way, and they don't even know they're working against themselves. And it's tough because I don't want to also be the person that's like, the only people that should be in this space are the ones that don't need money. But like, you found a way, you made sacrifices, and you decided, I'm going to do the right thing, even if it costs me. And in the long run, it's made you probably lots of money, and you're very blessed. But you started with a pure intention.
Yeah, more than money though. It's brought me legacy.
Yeah.
I mean, my impact this industry will last long while I'm in the grave, right? The impact that I've had to my own family members who've been able to benefit by the knowledge that I discovered, the benefit to myself. I mean, I've been buying income since 20 years ago, and I'm 63 this April. So I'm getting ready. My first bucket actually kicked in as a Roth IRA, and I'm redeploying that money right now. I've got another one that kicks in at 65, and I got a big one that kicks in at 70. And so I build inflation, I build guaranteed, promise-based, reliable income into my retirement. And I'm chasing alpha like nobody's business right now in AI and all these great stocks that are moving and shaking, and I've got great life insurance growth. I mean, I've got the best long-term care you could own. You can't even buy what I have today. But I actually implemented and did the very things that I advise my clients to do. But I live very frugally. I started at 23. I had 2 nickels to rub together. I was a Prudential debit agent. I called myself a life insurance cowboy. I hated my job. I looked younger than I was. I was the 6th agent in 3 years for the same debit. And you call a client, they laugh at you and say, if you're still here in 6 months, call me back. And so it was very tough in the beginning, And but the rewards have been great over the years.
I want to get into annuities. I want you to define DIA, deferred income annuity, and the difference between the other annuities out there. And then I also want to talk about, what does Fisher Investments and Dave Ramsey and other people that literally believe, or they communicate, that we're actually taking advantage of people? Like, that must be so infuriating for someone like you. So let's take it one at a time. The difference between a DIA and a traditional annuity, fixed income annuity, like, how do you describe what was so unique of what you discovered? Because annuities aren't anything new, but you discovered a special type of annuity. And just in your own words, what's the difference between a DIA versus other annuities?
Well, let's just start with a SPIA. It's been around forever. It's been around for, back to centuries ago. It's how the monks got their pensions. An income annuity, whether it's an immediate or deferred, an income annuity is nothing more than a pension. It's pure and simple, a pension, and it can be a lifetime pension on one life with no promise that if you die too soon that any money is preserved. It can be a pension on 2 lives, husband and wife, that protects the parties until the last one dies. You can protect the legacy of the principal value via an installment or cash refund. So it's a base you can't destroy, one you can't outlive, and principal you can't lose a dime of. Think about what I just said. And so that's a very distinct product. But one is an immediate payout. I got to start within 12 months of the deposit. And one is 13 months up to, there's some DIAs out there you can start 50 years from now. And so it's a deferred income product. Now, why? Why would I care about this? Well, the reality is, if all I'm doing is I'm buying products that I hope that mortality credits haven't got super expensive because medical technology's got everybody living to 110. Can you imagine if I can get a 7-8% distribution on an immediate income annuity today, at my age and my wife's age on joint life installment or cash refund, if mortality is increased 5-10 years from now, 5-10 years, can you imagine how little for the dollar I'm going to get compared to what I could get today? See, if I wait to buy that SPIA, I have no idea what the SPIA is going to give me. But if I buy a DIA today for a date in the future that has flexibility on when I turn it on, I've locked the factors in. I've locked the mortality in, and I've beat the market on the allocation to the fixed allocation location of the money that I did. I don't have to worry about it anymore. I did 20 years before I retired. I did 10 years before I retired. That's the magic of a DIA, is I can compete with the market with no fee drag and absolutely lock that number in. It's kind of like
And eliminate volatility.
eliminate every risk.
That's a big statement. That's a big statement.
Now, people say, well, what if the company goes belly up? Well, do you think we just do one company if we're doing a big sum? I did a big case in Fort Collins, Colorado, where the client did $5.6 million, hit $50 million, hit 15 held hostage in a bank account. He's trying to generate $25,000 a month in income. His broker referred us to him. We took $5.6 million in guaranteed joint lifetime with installment refund, cash refund for the rest of our lives. And we freed $6.4 million of money that was free to do whatever they wanted. Life insurance bought, assets under management were bought, all kinds of planning was done. A large estate plan was created. And guess what? All with the 15, we didn't have to touch the rest of the pile. And so the reality is these things create possibilities. But that client, where I was going with this, we did 20 companies. Some on her, some on him. Why? Because there's a statutory reserve. There's $1.05 on hold for every dollar, unlike FDIC, which holds pennies on the obligations, and they collect money through extra premiums that they charge to the banks when there's a failure. Trust me, I was on our bank board. I understand what happened in 2008 and 2009 when we got a special assessment from FDIC when banks started going failure. We wasn't even in our budget, but we had to come up with more than what our regular premium was for FDIC. They do a similar thing. Well, first of all, you got statutory reserves, which always is being monitored every quarter. And if they fail 2 quarters in a row, they're considered insolvent. Those assets are frozen, taken over by a financial professional management firm, and preserved for the policyholder claims of that insurance company. If those reserves aren't enough, then it goes to state pool. If state pool kicks in, then they send bills out just like the banks did to all the standing insurance companies in that state. And as long as I don't go above the state pool limit with any present value of any purchase I do with these guarantees, I have triple play protection. I've diversified my fixed income purchases like I would my diversified investment portfolio, but I take all the risk, all of the risk off the table in the environment by which the federal government has protected these assets.
Only if you're a little bit more passionate about this, it's just putting me to sleep and just, I think the only person that might match your energy is Tom Hegna. You guys are just amazing. Like, you make me want to run through a wall to sell annuities. It's just amazing. All right. So are you familiar with the White Coat Investor?
Yes.
What's your initial thoughts on his blogs? He hates whole life insurance. I'm not sure his stance on annuities, but what's your take on just what he teaches?
He's isolating the analytics for his own benefit because he's got to hair up himself about life insurance. Okay. And I just think that, Rockefeller was mentioned on stage yesterday by the Legacy fellow, right?
Yes, Garrett Gunderson.
And I went to Garrett and I talked to him. I actually was doing business with David Rockefeller, the final siblings of the Rockefeller family. He had a personal assistant and he had a chauffeur. And the personal assistant and the chauffeur were a married couple. And they had me meet at the Rockefeller Library, the mansion, the Rockefeller's mansion, New York. And the library, we did all the applications where they bought income, chased alpha. And they buy lots of life insurance. And what I would argue to anybody that dismisses life insurance, wealthiest, highest tax-paying people in America, biggest corporations buy life insurance. How could somebody that dismisses life insurance ball and glove, like there's never a time it's worthy of your consideration, how can that be true? And so many bright, educated, and wealthy people who have the best minds as accounting and legal analytics working for them, and all this life insurance is sold. So there must be something to the life insurance story just by the observation if I'm a consumer. But we know the difference, and it's you've got to get into the details. You got to get into the differences between the taxes, and you got to get into the differences of the fee drags. And there are probably some life insurance policies today that are being sold that shouldn't.
Yeah.
And there's probably some policies not being sold that should. Yeah. And there's always going to be those truth gatherers and those evil ones that share information that's not right. But authentically, those that should have life insurance combined with annuities and traditional investing, nothing fixes or creates an opportunity for those consumers, those clients, better than the combination of those products when properly positioned.
I love it. You've said a couple times, chasing alpha, buying income.
Buy income, chase alpha.
Buy income, chase alpha. Is that your framework on how you help people?
When you buy income, chase alpha, it frees the hostages. Let me give you an example. 4% rule.
Yes.
Got $1 million. Been saved my whole life. Me and my wife put our 401k together, rolled to an IRA. We got $1 million. Let's say it's three, just because I got the math here. Let's say it's 3%, $30,000 for $1 million, right? That's 3% rule. You can convert it to 4 if you want. But let's say I need $90,000 of income.
That's $3 million.
Well, no, I've got $30,000 pension. I'm lucky enough to have a pension.
Great.
I have $30,000 Social Security between me and my wife. I need I got a whole $30,000, and if I need $100,000, I've got a whole of $40,000, right? Well, if I got $1 million and I'm going to adhere to the 3 or 4% rule, how much free liquidity do I have when I retire? The answer is 0. Why? Because I have to hold hostage that $1 million. I can't spend one more dollar without taking a higher risk of withdrawal drag. And if the market misbehaves in the red zone, that first 10 years of retirement, I'm on a slippery slope to 0 really fast with longevity. Who knows how long it may last? And so I can't touch a penny of that. I'm held hostage with a gun to my head on the performance for that money for next year's safe withdrawal. Now, if I have $2 million, now I have $1 million of free liquidity. I literally have unfettered assets to go to the casino, give to charity, pass to my kids, buy life insurance, take long-term care risk off, chase alpha as risky as I want it to be. I now have free liquidity to do it. But till I buy income to free hostages, dollar hostage in my portfolio, I can't chase alpha. I have to constrain for a safe withdrawal rate until I approach the day of retirement. And it cuts me off at the head.
I love it. So you're figure out what that income number is. Figure out that income number, I would assume, with as few dollars as possible. And then everything else, you can chase alpha, you have liquidity, you have opportunity.
Yeah. So I'll give you 2 examples of my own products. And you can do the math. So in 2009, I bought a 5-year bridge of income. I'm 45. I realized over my years of research as an academic that usually in a traditional interest rate environment, the earlier I buy, the higher the IRR for the bridge. And so I tested this, 5 years out, 6 years out, 10 years out, 12 years. I went all the way to the 20th year. And every year I delayed up to the 20th year, I got an incremental increase to the IRR, the internal rate of return. When I went to the 21st year, it was either negligible or not at all. And so I realized that the insurance manufacturers, by and large, know how to price performance up to the 20th year deferral, but they have no idea how to bet on it after that. So my rule of thumb is never buy income more than 20 years in advance. Most will never going to do it anyway. Most are going to do it 5, 10 years ahead of time. But 20 is, I'm an extremist, so I did it. You know why? Because I got a 7.34% IRR with no fee drag on money that I needed for a 5-year bridge. I put in $50,000. In 20 years, I get 5 years of payments for $50,000. I get $250,000. The IRR was posted actually on the Prudential quote. I got a 7.34% with a 21% exclusion. 21% efficiency to tax, and I'm pulling money from my fixed allocation of my portfolio to lock this in. So I actually got about a 2.4% increase to my performance over what I was going to get negative fee drag on my fixed allocation in the market at risk. That's one example. And so these products are not inferior, right? If I die because I did installment or cash refund or in a period certain, my heirs get all the deposit and they get all the gains on the period certain. But then I did another one. I bought a $500,000 New York Life contract when I was 60. That was nearly 3 years ago. It was 3 years ago in January, actually. That last tranche of income, I want to start 70. By the way, if I'm in a 3% withdrawal rate, at age 70, I need $2.8 million generating 3%. to take $82,000 a year of income, which is my goal, $82,000 off that tranche. Well, I realized that when I went out and did the quote in January, or actually it was December of 22 that I did this, I realized I didn't need 2.8. Now, to be fair, if you say, well, if I got 10 years to grow the money, but I've got constrained to save withdrawal rates, I can't just chase alpha. What performance would I have to make on a present value today to get to 2.8? So I did the math on 1.8. If I had 1.8, I think I'm going off memory here, but I think 1.8 at 8%, 1.6. 1.6 at 8% without fee grows me to 2.8 in 10 years. Okay. Reality is I didn't need 1.6 either. I only needed $500,000, $500,000, bought me $82,000 in 10 years, guaranteed with installment. That's going to be cash refund to my heirs. Okay. Well, if I didn't need 1.6, I had $1.1 million to chase alpha. Yes. In 10 years, where do you think I'm going to have more money? Constraining my portfolio for a safe withdrawal rate of $82,000, or taking $500,000 and carving it off with guarantees?
Yes.
And then chasing alpha on 1.1. Where do you think I'm going to have more money? By the way, if I'm the advisor and I get 4% on the commission, I get 4 years up front of my AUM, plus 1% credit for getting it all up front. That's 5 years worth of AUM all up front. Yeah. Do I recover taking that 1.1, my AUM, in year 6? Nope. Do I get it in 7? Nope. It's minimally sacrificial. How about 8? Nope. 9? Nope. 10? Maybe 10. In the 10th year to 11th year, I'm going to break even where that pile's back at 1.6. And I'm going to, over the next 30, 40 years of that client's retirement, I'm going to make more AUM than I would have ever made than if I would have constrained a portfolio for a safe withdrawal rate in 10 years to get a 2.8. Trust me, we've done the math 16 ways to Sunday. This is not sacrificial. I don't have to do what I used to think I had to do when Joel Szilard told me what a bad idea this was because of revenue.
In other words, do the right thing. You'll actually get paid more in the long run.
In the long run. You got to put yourself on the same side of the table with the client. You got to be willing to sacrifice for a short time what's great for them and great for you. I mean, managing assets where you have no draw requirement out of the pile that's in the market, you can have buffer assets just in case, but you don't even need to use the buffer assets.
Yeah. What's your thoughts on how does life insurance get integrated into this? And I also want to talk about your software. But okay, so you're a big annuity fan. Obviously, you're not anti-investments. How does insurance integrate and make that situation better, or does it?
Well, let me tell you, it starts when they're 18 years old. The one thing I talk about life insurance to advisors that I teach and train my 2-day class, Thrive University, is the best thing to talk to parents about when their kids are graduating from high school is not a shiny new car, new pair of jeans, a pair of Louis Vuitton boots for her. The first thing they talk about to them is buying $1 million of 20, 30-year term life insurance on the 18-year-old. Let me tell you why. You know, when you say that to a client for the first time, there's this knee-jerk reaction, this emotion that says, oh, you think I want to profit on the death of my kid? That's the first thing that comes to mind. You say, no. That's not what I'm talking about. But if I had $1 for every 18-year-old that graduated from high school, who got married, had a mortgage, had kids, and got diabetes, breast cancer, testicular cancer, things that cause them to be uninsurable later. You're not buying this to be wealthy if they die. You're buying this to preserve and protect their future insurability. And of course, you don't go into this at the time you're talking when the kids graduate from high school. But we also know that we're building a base of a convertible product that locks in insurability at a reasonable price for a product they are not going to afford yet. But we're setting the table for what's yet to come, because buying that permanent portion of life insurance as young as possible is where they're going to get the greatest buffer benefit possible for their retirement. And you just need to set the table, and you need to be coaching along the way. But I tell clients, if you buy a 20-year term policy for $1 million on an 18-year-old, it's $20 to $25 a month. And I'm not talking about the cheapest. I'm talking about one with a carrier you would be proud to convert to their permanent policy.
Yes.
Okay.
Convertible term.
You got to set, but term with a company that has conversion options that you'd be worthy of having.
Yes.
Right?
Yes.
And so I sell more life insurance to parents for 18-year-old graduating seniors as a setting the table for their future insurability and the protection of their families. And I convince parents to commit to doing that for their kids. And why $1 million? Well, you can sell $1 million to an 18-year-old no matter what the wealth of the family is.
And they can afford it.
They can afford it, but the insurance companies aren't going to balk. You try to go more than $1 million unless they're a special wealthy family, insurance companies aren't going to sell you more than $1 million on an 18-year-old. Otherwise, I would tell you to buy all you can at $25 a million.
Yep.
And if you want to have a great career selling life insurance, start selling all your parents for their seniors.
Yeah.
20 and 30-year term life insurance is a tee-up for their future.
Talk to me about why life insurance unlocks options and potentially makes someone's situation better. Like, I would imagine if someone had permanent life insurance in their 50s and 60s, it gives you, from a planning standpoint, more options than if they didn't.
Well, so I bought a policy when I was 28 where the payment was bigger than my house payment.
Wow.
And I wasn't sure I could do it. And of course, today, my dividend, I have participating whole life. My dividend, a guaranteed increase in cash value, are 3.5, 4 times my annual premium. Now, I wished I would have bought a variable life policy, to be honest with you, because I wish I could stuff. I wish I had a higher MEC limit.
You have a first world problem of not being able to put as much money
I'm
as
limited
you want.
on how much I can put in, because even if I put a PUA rider where I stuffed money in on the front end, you don't fund those for 2 or 3 years. You can't fund the PUA rider anymore. So I'm constrained on how much I can put in, but I would never think about not making the payment because I want to grow that cash value. It's growing at a clip of about 6% with dividends and the dividend on the dividend, the guarantee increase in cash value. Net of all expenses, net of all fees, it's like one of the best fixed allocation investments I have. It's a buffer asset. So if I have to pull money out of something that would be like, I've got a great investment in my after-tax portfolio and I don't want to sell it. And maybe I want to touch my Roth IRA, but anything else I touch would be somewhat taxable, long-term or ordinary income tax. I can go in there and take my basis from the policy for a month or two until something else pops up or make a little more income. I turn around and pay it back with just the interest associated with the number of days it was loaned as a buffer asset. No tax at all. Very cheap cost of capital, liquidation, and availability. And so I use it as a buffer, not just for retirement, but, I did when I was on the farm and money got a little tight one time. I needed a new lawnmower that would mow 8 acres a week. And this lawnmower wasn't the lawnmower you think about in the city. And this is 72-inch front mount diesel hydrostat. That is an expensive lawnmower. I borrowed the money out of my life insurance policy because the only other place I get money at the time was my 401k as a loan or a distribution prematurely out of my IRA. And so I wasn't going to do that. And so I took a loan out of the policy and bought that lawnmower for my family, and we paid that money back. But it creates capital where you can be your own bank. I believe in many, not all, the infinite banking concepts. If I found investment property, again, be careful here, but if I wanted to throw some money in on an investment, I could double down and create an investment property income and use that distribution of that income on an investment property to pay my loan back. Again, I'm not advocating these are all appropriate for everybody, but the fact is I have the option. I have the flexibility. Building flexibility into retirement, building flexibility into capital is the most powerful thing we can do. And the unfortunate thing is that a lot of advisors perceive it when you buy and lock down money in an income annuity, you've limited your flexibility. No. Because you so constrain the allocation for the distribution guarantees that you're getting, you freed the maximum amount of dollars with no risk. And so, by the way, do the math on mine. If I put $500,000 in, I'm getting $82,000 a year. Am I getting 4% back? Am I getting 8% back? It's a high distribution rate. that I'm getting back. So forget the 4% rule, forget the 3% rule. I can say that because I locked in guarantees. Now, I breached one of my own rules I already talked about. I keep usually my present value cost on any insurance product I buy at or below $250,000. Why? Because that's the state pool limit in the state of Iowa. The exception to the rule for me, and this is a great commercial from New York Life, is New York Life, the best ratings in the industry. Because it was New York Life, I didn't care that I went to $500,000.
You're not laying in bed wondering if New York Life is going to have a bad.
I have a lot of confidence in New York Life.
And by the way, if New York Life goes under, we have bigger fish to fry than your personal.
I thought I'd mention that because it did break one of my own rules I mentioned earlier. But
you're the annuity guy. Anyone ever call you the annuity king?
I was Dr. Dia for a long time, but let me tell you why I resisted it.
Yeah,
is because there was so much negativity in some of the arenas I would speak at, financial planning, all these different conferences where they're asset under management, kings, and if I was known as the annuity guy, there were stages I was never going to get on.
I understand. Yeah.
And so I said, stop making me the annuity guy. I am all things retirement.
Retirement. Yep.
I mean, if it's assets under management, I have an asset under management firm. I build portfolios and we don't use third-party asset management and we buy stocks and bonds and I customize every portfolio for every client. And yes, I still do that.
Yes.
It's not the easiest way to make money, but I believe in assets under management in a big way.
Yes. No, and the reason I mentioned that is life insurance. Do you endorse the single premium, like the SPIA or the deferred annuity single pay option if you have a death benefit to cover?
Yeah.
There
was a period of time when you could almost fight both sides of that fence with the insurance manufacturer. Insurance companies didn't want to be on both sides of that risk.
Yes.
So you just had to go to two carriers. And then interest rates got so low where the rates of life insurance premium went up and the payouts on SPIAs went down. Arbitrage didn't work. But if I bought a permanent policy at 35,
it worked.
And at 65, I have still another tranche of income to buy, even if I'm buying it 10 years ahead of time in a DIA or I'm buying it at retirement as a SPIA year out before I retire.
Yeah.
I can afford to do life instead of installment or cash refund with a little bit higher payout if I have the death benefit, or maybe not put my wife or spouse on as joint lifetime if I have a life insurance to arbitrage. Now, I will tell you that most of the time you're giving up about 11, 12%. It's still hard for anyone if they're throwing $500,000 in the tank to think they could hit a Mack truck tomorrow.
Yeah,
they had the life insurance and $500,000. It's hard for them to get over the fact that they would lose something for their heirs. So most people, if it's 12% on the line, will still keep the life insurance and still do the installment refund.
I understand that.
But it's an option to talk about if somebody really can emotionally go. I'll tell you the people that really are able to talk to about this, people that have never been married, don't have kids. They don't have a legacy fear. And only time they do is charity is what I find. Now charity makes that's almost worse than having a kid, right?
Yes.
I want to take care of this charity. So they're all viable conversations. They're all great strategies. But sometimes what you perceive might be, well, that's a great idea. Clients can't get over it, can't hurdle it emotionally.
There's a lot of software out there. Why should someone look into your software and talk to me about, like, in 2007, you started this and you've obviously developed it further. What about your software should people know if they're hearing you for the first time watching on YouTube? We'll obviously have a link to all the things that you mentioned, including them to learn more about that.
So we're bringing insurance products into the retirement income space, products that have sometimes no taxes, tax efficiency, tax exclusion, don't even get counted against the Magi and IRMA tax for Medicare Part B tiering, right? It's like if I have a municipal bond, it's state municipal bond. I'm not paying state tax. I'm not paying federal tax. But when the IRMA calculation gets calculated for what tier I have to pay on a means test based on how much income I make, it still affects IRMA. Insurance products are one of the rare things that not only is it not taxable when it's not taxable, it doesn't count against IRMA. And so if I have a software that's not doing progressive, dynamic tax calculations as a real tax return under the hood based on all the components being put in, I'm using a 25% average static, and I don't have any IRMA in there. Well, I'm not even halfway comparing the contrast between A and B. I'm not even being fair to myself, let alone I'm 30, 40% off of my analytics to the client and what I'm telling them. Because by the way, most clients are in the 22 to 24. I heard 25 today. There is no 25 bracket today, right? And if I'm in the 22, I'm probably in the 12 bracket. In other words, there's if a husband and wife, I'm 35,000, no tax at all. Then the next portion I'm at 10, next portion I'm at 12, and then finally I tip into the 22. Well, what if I barely tipped into the 22, but I'm in the 22? What's my composite dynamic
Way
rate?
less than 22.
It's like 12.
Yes.
And I'm using 25? I'm using 25 to discount the taxable products versus my product? Well, first of all, is that right? Is that fair? That's bullshit.
Yeah.
Really? I don't have dynamic tax? Well, that's the problem with a lot of software. It's not dynamic tax. That's the first thing. The second thing, inflation. There's a lot of software that promotes inflation. However, we break it down in 5 different inflations. Let me explain. Do you think that if I'm inflating lifetime income style, do you think that I should inflate lifetime income style the same as what my medical cost drag inflation is going to be in retirement? Or do you think those are 2 different inflation numbers? And so generally, lifestyle income is inflated 2 to 3% depending on your geographic region. Iowa, 2%, 2.5% is probably enough. In New York, I don't know. But medical inflation ought to be 5 or 6, right? Well, what about inflation from Social Security? Well, we inflate that about 2. I could be wrong. It could be more, it could be less, but it ain't 5. It's not 2.5 and 3. I have to have a different calculation for that. And then what about the mortgage that's not paid off until 5 years into retirement? And that annual life premium, I did a 10-pay, I got 6 years left, I'm retiring. I throw that into the pile of lifestyle income, I'm inflating at 2.5%. Should I be inflating the cost drag to my mortgage that's fixed to that premium that doesn't go up? Or should I isolate those so there's no inflation being calculated in them at all? So it's just logic that I have to separate.
But you have to go the extra mile. And
you have to go the extra mile in the software, and it costs money. Nobody wants to do it. Most of these things project annually. People don't live annually.
Yes.
Do you know how people live? Monthly.
Yeah.
So we take it all the way down to a monthly projection, so our tabulars are monthly, and then the taxes are annual. And so we painstakingly spent the money and the effort to do all these extra things to make sure we have dynamic tax, progressive tax report, that we're doing dynamic inflation across the board. And the last thing we do is when we plug in the portfolios, we literally plug in every tax class of portfolio by class. So how much is in fixed income? How much is in equity? How much is in alternatives? And we identify a reasonable, and the client has we have a process to get the client to put a stake in the ground of commitment of what they think over the next 5-10 years, a good projected rate of return for that class is. Not what we think, not what the industry says, but we first want to know what they think. If we use a number and we force them a number, they're not going to believe in our analytics. But if we use a number they gave us, but then we take them to the report and we show them what the actual fee drag is. The report tells me what they're paying in fees to their broker. Then we go over after we put in the average and we put the actual fee drag they're being charged. So the composite rate of return, when this all is input correctly by tax class, is it shows a composite return that's not anything close to what the client thought it was going to be. It blows them away. It also brings my hurdle rate on how much my income by income story needs to be. That's why it's never hard to beat the outcome.
Yeah.
So I have to have dynamic fee drag, not just inflation and taxes. It's what makes us completely different. And then finally, the real thing that separates us is we have a pictorial retirement income dashboard boiled down to 4 pictorials that matter. Everything, only things clients care about are those 4 pictorials. And it's legacy, withdrawal drag, measuring withdrawal drag, reliability of income, how much is promise-based versus risk-based, and how much free liquidity do I actually really have? Those 4 things are pictorially contrasted against multiple alternatives, and then, of course, tabular reports behind. And that's what makes us unique. There's nothing out there that does exactly what we've created here.
Curtis, I just want to thank you on behalf of this, our profession and industry. I'm 29 years old. I hopefully have a lot of life to live, and I get to benefit greatly from the work that you do and the work that you've paved the way and that you're continuing to pave the way. And so thank you. Sometimes we take that for granted. Sometimes the easier life gets, the lazier we get. And I want you to know that I'm committed to doing whatever it takes to furthering this message and getting more people insured, having more people protected, having there be greater efficiency. And I believe that this conversation that we just had is going to inspire a lot of people. I want to hear from you on YouTube. I want to hear from you. If this impacted you, please, we'll include your contact info, and please shoot Curtis a message. We'll have your information for your event, the software. If you want to learn more about that, if you want to talk to someone about your personal situation that uses your software, there'll be a link down below there. And anything else that you want to leave our audience. You have been so generous. This exceeded my expectations for this sit down, and I'm so grateful for just this conversation that we got to have.
Well, just tell you to reach out to go to my website, curtiscloke.com. Call my office, 515-298-4748. My office manager schedules everything for me. If you want to talk to me directly, it's Michelle it's M Gephardt, MGEBHARDT at thriveincome.com. I'm Curtis Cloke. We love retirement. Let's talk retirement. And thank you very much for your time today.
If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we going to have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there.